Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and the buy price for the stock. Today I'm going to analyze Caterpillar, which is one of the biggest companies in the industrial sector. Last, they generated a revenue of $51 billion and they have a market capitalization of $120 billion. Caterpillar generates the value by selling or leasing equipment, engines and more to different companies in different industries. The revenue of Caterpillar can be divided into three main segments, which are construction industries with 42%. In this segment, the company's machine sales are made in things such as heavy and general construction, mining, and so on. Energy and transportation with 49%. In this segment, engines, turbines, and generators get sold among other things. And the last segment is resources with 19%. Where the machinery mainly gets used for mining, heavy construction, quarry and aggregates. Regarding the geographical diversification of the company, it is informed that 43% of the revenue is made in North America, 24% is made in EAME, 23% is made in Asia Pacific, and the last 10% is made in Latin America. If you want to know the exact numbers of how the revenue is divided, you can check out the annual report of Caterpillar, which I've linked down below. Enough about the introduction. Let's find out if Caterpillar is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Caterpillar is the dividend yield. I'll start with plotting the dividend yield for the last 2 years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simpler approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.5%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Caterpillar is 9.3%. The starting point for my weighting model is the just calculated historical dividend yield of 2.5%. To the historical yield, I add a margin of safety of 25%. Although this value will be adjusted upwards or downwards depending on how well the company scores at my weighting model, where I always use the same 7 matrix. The first matrix I use is the earlier calculated relative standard deviation, and the 9.3% of Caterpillar are in the yellow section of the weighting scale. Therefore, the margin of safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix to me. In 2007, $1.32 were paid, and in 2022, $4.58 is expected. Caterpillar has paid and increased the dividend for 29 consecutive years, which makes them a dividend aristocrat. In the last 5 years, the average dividend growth was 8.1%. This is a good value and in the light green section of a rating scale. Therefore, I'll subtract 5% from the margin of safety. By looking at the payout ratio, I found out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. In consequence, this is in theory the money the company has available to pay the dividend without damaging their position in the market. The free cash flow from Caterpillar has increased from $5.4 billion in 2018 to $6.1 billion in 2021. The cash dividend were respectively $2 billion and $2.3 billion. The average payout ratio thereby becomes 39%. This value is once again in the yellow section of a rating scale, and therefore the margin of safety doesn't change. Before we continue the analysis, I would like to remind you that if you like my stock analysis, you can support the channel by liking the video and subscribe to my channel if you haven't already. If you also would like to support me financially, you can check out the links in the video description, where you can open new portfolios or buy some great investor books. With that being said, you can of course also just continue to watch my videos, which is already a huge support. But now, let's get back to the analysis. Next, I'll take a look at the debt situation. The company has a debt of $28.5 billion and have $9.3 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $7.9 billion, which leads to a debt to equity ratio of 244%. This matrix tells us that the company could pay off the whole debt in around 2.5 years if they wanted to. This matrix is inside the yellow section of our rating scale, and therefore the margin of safety doesn't change. If the goal of an investment is to buy and hold the stock for decades, it is important that the financials of the company are sustainable. And for this reason, I have plotted the revenue over the last few years in a chart. It can be seen that the revenue has increased from $45.5 billion in 2018 to $51 billion in 2021. This gives an average growth of 2.9%. Likewise, the EBIT increased from $7.6 billion to $7.9 billion, which leads to an EBIT growth of 0.9%. Now that we have the revenue and the EBIT, we can calculate the margin by dividing these two numbers. In the year 2018, the margin was 60.8%, and in the year 2021, the margin decreased to 50.5%, which gives an average margin growth of minus 1.9%. On my weighting scale, the EBIT growth is just inside the red section, which gives plus 5% to the margin of safety. And the minus 1.9% from the margin growth is also inside the red section, which gives plus 10% to the margin of safety. The last thing I'm looking at is the potential yield on cost. This matrix tells how great a potential investment in Caterpillar would be and what annual income I could expect in a few years. Caterpillar has a dividend yield of 1.98% and a dividend growth rate of 8.1%. I assume that the dividend gets fully reinvested at the same conditions, but I'll subtract 15% from every dividend payment because there are 15% withholding taxes for stocks from the US. After 5 years, the yield on cost would be 3.3%, after 10 years it would be 5.7%, and after 15 years it would be 10.7%. I only calculate the potential yield on cost for the coming 15 years because of the natural uncertainty of this matrix. But a yield on cost of 10.7% after 15 years is not that great, and in the red section of a rating scale, and therefore I'll add 5% to the margin of safety. Now that I've collected every adjustment to the margin of safety, I can calculate the final margin of safety for the company. To summarize, I'll subtract 5% for the dividend growth, but I'll add 5% for the EBIT growth, 10% for the margin growth, and 5% for the potential yield on cost. The final margin of safety thereby becomes 40%. By adding the margin of safety to the historical dividend yield, I can calculate the desired dividend yield for the stock, which is 3.5%. By a current dividend of $4.58, the buy price for the stock becomes $131. Now, if I wouldn't add a margin of safety to the stock price, but only want to achieve the historical dividend yield, I can calculate the fair price of the stock, which for Caterpillar is $183. To better understand these numbers, I have plotted the margin of safety curve in the historical yield chart. This new curve always lies 40% over the historical yield curve. Now you can see in the graph that the yield curve is under the historical yield and the margin of safety curve. This suggests that the stock is currently overvalued. This can also be illustrated in stock prices. I consider the stock at its fair value when the price is $183. I would buy the stock at $131, and the stock price is currently at $231. That's it for today's video, and thank you for watching.